Calling ambulolo cool with whatever we do. Jioni safu no la with whatever we do. Hale yide munyu skula nyepamne ne kudlukula nyepangi ragala gena nyepamne ne kudlukula ibuloke nongoto ni beti sola ibuloke dato ni betoto
Mingi Congo
Lamin
na
Lamin te jibe norin te nyame Lamin
kabana wulokono
nyinta mo Lamin
pabilenki
muna ngata afamole
haina
ngata ngoto le Fabrama
Mingi baba nyola
ngoto le Fabrama
namu jumara kan kuma diten
Fabrama
jumara mu
ndele bare muso
lunda mana
mo kata
jamani mbere
alindo ko
jamani
bari ngoto man kontande
bari jamani fana na ramudu ma kontan
ngoto minaka ngala min de fon filitala Lamin jibe nori nyaala
Lamin ila siran sama ne benki yala so tol sayni no ko mo lakko momo
ngoto
nam
itedinte yalo ne Lamin hakkilo diata bake karambugoto anu santeng ministry ko di ngole si suko na amake ko do holi de
si biton
bagona de
ala ni ko kede namo balo
ala ni na ko na carte bulo be dam ala ni je
ngoto
nam
ngoto mon kontan fere
jamani mu ne keda
ite ka Lamin ki wulo ko nyin tay mon ko do fete malo Lamin nyanta sila la be la moy kala karango
jamani karamol be sorande ne ko fasita wulo ko nako
karambugol ma soron ni ko karambugol soron da amake kom holiday lem ngoto dini ngo nyanta sila la ala karango la moy yamen kamen fue man kontan andamande
alla nyin kombo courant adanda kombo len do la jan karamol le soron do kamen courant ma daro lo kombo e don do fana na karamol soron je karamol soron Lamin adara lo nyino la amantara fe na sokon ala mu nekela
Lamin ite foyde malon ko lesinol be ke kar radio to
nga fine
e ko yana di mod Lamin ya mu na fonye
bi kabin mina kan ntambita nteri mañing Fatou ntambite la sugal ala diningol bebe siri be la motka
Fatou danso am fana tambita jele ni subala la ngaje diningol be jet talanta nen kili warol e be serin jele
sa Lamin fadante ku kili wo ke no la ba Lamin bita ka wulo ko no nyin taymo Lamin
amandara fennala
ite dine ko ni man si yakari lesinol la moy radio to e balon na
mu ne ka ke afonde ba nyande alon
telentel kot
afonde ba mu ne be ke
ite balontel be cikritel ni man karambe ku kele yaje nata karana mbasa malaya ay tarije
bar ñarande kombo courant ho findira kombo ide na raje den sonka bay ko Lamin manya tala wulo ko aru karam mo be so afonde membe
ko to wole nati bawo ngalle ni Lamin kuntala kombo courant o ka fa me kombo courant asototal wala kinay ko e sisu ko no bari ni ko e sisu ko no be karangol dike la radio lin telel to hani tele masoto to nyaay man tele soto la bungo bar radio be bulan ko to batiri sanga ay si ay alamo
sa do kala
nyaadi ko ta o bulaji
ado kala nyaadi
kamun ke nyaadi
radio abe wala mo la be mona falaje
ibe la karandirol kala jele
ti talle be radio ko men ka karande
ila subject ro baby jele baby jele
wala nanga coco moy fa dan so wolya ngombe tambi kana ngadi ningol de be ikadum bungo de ko kala mo
ma asototal de
Lamin mala be kara wala de
bari laftalal ideal on ko inde every year second wala fo
muna ni ko di ko nde ko folle sinila ba ndele sinilo na ba
mbasa mba fo ke ngoto wole fango ye ngulindi yalo famo keta bat ñu fana bulata ko ko me yen nati jambi Lamin nyanta karana ntel beji ko be nyineka ya bulay kara wulo kono ta kilar ya bambalo yo be bulaje ngoto dindi ngoy si ayala le sino la moy radio
wora ka munda kara mo man so Lamin nyanta kara si so na radio
la sila le ayala le sino
dal ko korno ko smolon
kilar ya
mo be ngala ko mo sa mi do ni ko no kera
mengi bruzo
no ko do la da ba rosa no radio ba no bari woro radio ni abe je le ba ngamra do man dembe bulja dala nyara nyar wora bu ko fendi mo la Lamin tayra ba rosa
bara te ku folo ajibe nori nya labi tamete ku
muna na
teku
bari ko do famo ke
image nani nyambol si zol le ke je kisigi man si zol no le kabun ka nyoma bari nyambu kino ni manya na ka fendi ni nambe ko zol la ga
ngalle limbeta de be nyambo do dilanna
nyara ni ko ridin fennat nyara nata
bari famo ke da
nata bun kono tabi bun kono nyara ngando ko fele ko ke baru nganda ni pelo la dija
iyo a tar la
bun kono bismillah bisu diara
pendulala ye fongo tanka sina dolu tanka koro korota koro korota
Hello viewers and listeners, my name is Shriba. I will be teaching you financial accounting. And in our last lessons, we were discussing bank reconciliation statement, and then I started with telling you what is a bank, and after when we discussed what is a bank, then later we discussed what are the types of bank accounts, what are the types of banks account, banks account. Now, according to our explanation, we say that there are three types of bank account. We have the first one is called the current account. The current account is the first one. And what is a current account? These are accounts that are normally opened by either individuals or like individual who frequently use money, or businessmen. So under this account, which is current, normally businessmen open this kind of account because they frequently use money for their business transactions. So according to this account, there is no interest attached to this account, because the business will be saving money with the bank, an amount of money, and when they save money with the bank might not have the opportunity to be using their money because they can withdraw the money anytime that they feel like. So based on that reason, they're telling you that there is no interest attached. And if there is no interest attached, so the business will be making certain, the bank will be making certain charges to the business. And those charges can be, probably we can call them bank charges. They can be bank charges. So now, after the current account, the next type of account we have is what we called the savings. Savings is another bank account, another type of bank account where income earners can go and save money into the bank. And when they save money into the bank, they will save it for a little period of time, and whenever they need it, they can go to the bank and collect the money from the bank. But under this system of bank account, normally the Gambian bank, commercial banks are not applying the principle of savings, because normally savings, you have to save it for a little period of time, and later you can go and collect it anytime you need it. But now, what is happening, the banks are not applying this principle. What they do is that you can use saving account and you can withdraw it anytime. You can save it today, and in the evening you can go and collect it, which is against the principle of savings account. But under this account, bank account, there is an interest attached to this bank account, and the interest is not large, it's a small interest attached, not that compared to that of the next one. So there is a small interest attached for saving. For instance, when you look at different banks have their ways in which they can charge or give interest to the customer for saving with them. So we have different types of banks with different ways in which they can encourage their customers in saving money into the bank. So the last type is called the fixed deposit. Some call it the fixed deposit, and others call it the time deposit. Why did they call it time deposit? Because under this system, you deposit an amount of money, a specific amount of money, at a specific period of time. When the time elapses, you can go and collect your money. So because of the bank will know the actual time you will be withdrawing this money from them, so they are going to give you an interest. So this interest is bigger than the interest that is given under savings, because here the bank will able to use your money and they can able to do their businesses, and later anytime that you need the money, you can collect it with an interest. So the interest on the fixed deposit is higher than the interest on the savings. So after that, the next thing we need to discuss is, according to the learning objective we have, we will be discussing the meaning of bank reconciliation statement and what is the bank statement, and the other one will be the reasons for the differences, the difference we have in terms of disagreement. So the other one will be preparing the reasons for preparing bank reconciliation statement. So the next one will be the format for preparing bank reconciliation statement. The other one will be the method in setting questions on the bank reconciliation statement. So the next one will be how to prepare the adjusted cash book and the bank reconciliation statement. So let's see, how do we define bank reconciliation statement and bank statement? First of all, let's start with bank statement. Bank statement. Bank statement. Bank statement. According to the definition we have on the screen, bank statement is a statement prepared by a bank for its customers or a current account holder, showing the transaction between the bank and then the account holder. The transactions that increased the balance are credited, and the transactions that decreased the balance are debited. It shows the column for date, detail, debit, credit, and balance. So according to the definition, what they are trying to tell us that there is something that students should know. The first part of the definition is that bank statement is what? Is a statement. Is a statement. Or you can say is a document. So that's the first part. Bank statement is a statement. Is a statement. Statement prepared by, who prepared the statement? The bank. The bank statement is not prepared by the current account holder. It's normally prepared by the bank. So when the bank prepared this, they did not prepare the statement and send it back to themselves. No, they prepared the statement and send it to the customer or to the current account holder. Current account holder. Current account holder. So the current account holder here is the one that is making a business with the bank, is normally called the customer, because normally the guy opens current account, so the person who is holding the current account is called current account holder. So now, when they prepare the bank statement, they send it to the customer, to the current account holder. So the other part of the other part that you need to know under the definition is, when they prepare it, they send it to the current account holder. Then, what is the purpose? Is to show the transactions. The transactions between the bank. It doesn't show the transaction between the cash book and then the bank statement. It shows the transaction between the bank. Shows the transaction between the bank and the customer or the current account, the bank and the current account holder. So you see, it shows the transaction between the current account holder and the bank. So this is the definition. I repeat, bank statement is a statement prepared by the bank, sent to the current account holder to show the transactions between the bank and the current account holder. That's why sometimes when somebody wants to travel to America or any other place outside the country, normally the embassy will request what we call a bank statement. So the bank statement is not actually a physical cash, it's just a document. So why did they request the bank statement? Because they want to see how were you transacting with the bank. How much were you depositing? How much were you depositing? And how much were you withdrawing? So all these things, and then the next one, they will show the balance. So the bank statement will be showing the transaction that has been existing between the bank and then the current account holder. So now, after, when sometimes the question will ask you to describe, so students would understand this. Whenever you are given a question, they ask you to describe. Students should not stop here. You should not only start from here and stop at this place. You need to go further. And going further means you need to explain. And how are you going to explain this? So you can add this. Any transaction that increase the current account balance, current account holder's balance. Now, any account or any transaction that increases the current account, the customer's balance, in the bank, normally we are going to credit it. Just like accounting, under bank reconciliation, normally we have, for them they have withdrawal, they have what we call deposit, and they have balance. So accounting, under bank reconciliation statement, whenever somebody deposit money, normally under the bank, if you deposit, a customer happen to deposit money into the bank, they will credit you because it increases your balance. And if a customer is withdrawing is reducing your balance. So whenever you deposit, your balance is increasing. And if your balance increases, they will credit you. So why are they applying this principle? If you look at in accounting, when they say credit the giver. So if the current account holder is giving it to the bank, so they are supposed to be credited. So if you look at it in that perspective, you still get it right. But actually what I'm trying to explain here is, under the bank reconciliation statement, whenever the customer deposit, what happened? The amount of the value of money or cash you have into the bank is increasing. And whenever it increases, the law says anything that increases the balance of the customer into the bank should be credited. And anything that decreases, how does the balance in a customer's account or the balance of a customer in the bank decreases? It can decrease when the customer happens to withdraw, or there are other charges that are normally attached by the bank to the customer. So anything that reduces the balance of the customer in the bank, normally that balance should be debited. So we are going to debit when the balance of the customer is decreasing, and we are going to credit when the balance of the customer is increasing in the bank. So students will understand this so that they can put it into consideration, that sometimes when they set questions, they want to see whether the students understand when do the bank credit a customer and when do the bank debit a customer. So they credit the account holder when the balance increases, and it can happen when the customer happens to add more money into the bank through depositing. So anything that decreases the balance of the customer will be debited in the bank. So you will see this is what you need to know. So under the bank statement, you can further explain by saying that transaction that increase the balance credited, transaction that decreases the balance debited. So you can also go further and say it. Sometimes they say describe. You can describe how does it look like. So if you look at the format of a bank statement, is very simple. The format, we will have what we call the date, telling you when actually the transaction occurred. After the date, we have what we call detail, telling you what actually happened, the information involved. And we have what we call the debit, and we have what we call credit. Then finally, we have the balance. So it's very simple and straightforward. So this is how the bank statement looks like. So this is the description. We have the date, we have the details, we have the debit, and we have the credit. For instance, if somebody started, like the first time that you want to open an account with the bank. So for example, 1st January 2020. So maybe that was your opening balance. Accounting opening balance, we call it balance brought forward or balance brought down. You are not debiting, not debit, nor credit, they take it directly. For instance, 2,000. That's the first balance you have. That is called your balance as per the bank. So maybe the next day, you decided, not the next day actually, maybe on the 3rd, you decided, because you deposited, now you needed money, so you decided to withdraw, maybe cash. So normally accounting, the debit represents the withdrawal. So this is the withdrawal. So whenever you want to withdraw, maybe you want to withdraw 500. So what do the banks? The bank normally, when you withdraw 500, they debit you because withdrawal reduces your balance. So what do they do here? If you want to know your current balance, they are going to subtract 500. They take it from 2,000. So it is going to give us 1,500. So this is your current balance. So this is what I was explaining. Whenever your balance decreases, know that it is reduced. Normally, whenever your balance is debited in the bank statement, know that it is decreasing the amount of cash you have. You see, when you withdrew 500, what happened to your balance now? It has reduced from 2,000 to 5,000. Simple sense. From 2,000 to 5,000. So this is what I was explaining. anything that reduces the current account holder's balance, we are going to debit it. Now, for instance, on the 5th, the customer decided, the account holder decided to deposit another cash. Here, the customer is not withdrawing, is depositing. Decided to deposit 1,500. So you see, when you deposit, your balance increases. So what are they going to do? Now, if you want to know your current balance will be the previous balance you have plus what you are also depositing. 1,500 plus 1,500. Your current balance will be 3,000. 3,000. So you see, this is what I wanted you to understand. This one is a withdrawal. What happens to the balance is reduces from 2,000 to 1,500. So the next one, we have cash, but we are not withdrawing, rather we are depositing. So when you deposit, your balance increases. And when your balance increases, you are going to be credited. So you see, because of you are depositing here, the balance is increasing from 1,500 to 3,000. So this is what I was explaining. So let's go to the next definition. That's bank reconciliation statement. You know, if you want to know the definition here, you just look at the word reconciliation there. And you look at the word statement. Statement. We know that a statement is a document. And we know when do we reconcile. We only reconcile when there are disagreements, when there are differences. So here, when the business checked, collected, balanced their cash book, so they requested a statement from the bank. So the bank will print the bank statement for them. And when the bank printed the bank statement, so probably, let's see, the bank has printed the bank statement and they're giving it to the business. So the business checked that the balance that they have in the bank statement is 3,000. And when they look at their cash book, they compare their cash book and realize the balance that they have in the cash book. The balance they have, for instance, is 2,500 and we have balance brought down 2,500. You see the difference? So the balance in the bank statement is 3,000. The balance in the cash book is 2,500. 2,500. They are not the same. By right, the balance in the bank statement should be the same as the balance in the cash book. Because when a bank debits a particular item, the cash should credit it so that the principle of double entry will prevail. But after when we check, we balance our cash book and we ask the bank to print the bank statement, and they printed the bank statement, and we now compare the balance in the bank statement with the balance in the cash book, and we realize that now this one is 3,000 and this one is 2,500. They did not agree. So because of they did not agree, this is what we call disagreement. This means not, and agree means something that there is a consent. So therefore, because of there is a disagreement, so there is a need, because if you want the business to continue transacting with the bank, we need to make sure that any disagreement, any differences must be reconciled. And in order to do that, we need to prepare a statement to reconcile the disagreement between the bank statement and the cash book. So you see, there is a difference. And the difference between the cash book balance, this is the cash book balance, between the cash book balance, which is 2,500, and the bank statement balance, which is 3,000, is 500. So this 500, there is a problem somewhere else. We need to identify the problem, identify the causes, then therefore we reconcile the disagreement so that the balance will be the same. So this is what we mean by bank reconciliation statement. Now, let's look at the definition we have on the screen. This is a statement prepared by a customer we call a current account holder, sent to the bank to reconcile the disagreement of the cash book and the bank statement. So you say the disagreement, we can say it, the disagreement between, the disagreement, to reconcile the disagreement of the cash book and the bank statement. Or you can say the disagreement between the cash book balance. You should have put there balance, because is the balances that are wrong. You see, the balances are not correct. This one, the balance is 2,500. This one, the balance is 3,000. So they are not the same. So we need to make sure that we identify the causes for the causes of the disagreement, then we reconcile it. So the purpose of this statement is to reconcile the disagreement between the cash book balance and the bank statement balance. The bank statement balance. So the balance for the bank statement is 3,000. The balance for the cash book is 2,500. So therefore, the statement will help us to reconcile these two balances that are not the same. So we can go further. We can further explain if you are asked to describe or to explain. We can say it now. It is started with the cash book balance or the bank statement balance. This one depends. We can start with the cash book balance. We can start with the bank statement balance. But sometimes we are not given the bank statement balance. If you are not given the bank statement balance in the question, you cannot start with the balance as per bank statement. But if you are given the cash book balance, which is always given, you can start with the cash book balance. But when we start dealing with the practical, I will tell you what are some of the principles behind which one you should start with and when should you start with the cash book. And if you start with the cash book, what are some of the principles behind it? And if you start with the bank statement, what are some of the things you need to consider? So let's see now. After knowing the definition, they say it is started with a cash book balance or the bank statement balance, comma, then we have what we call unpresented checks, uncredited checks, and other errors as well are recorded. So normally if you look at the bank statement, under the bank statement we have bank reconciliation statement. Under the bank reconciliation statement, they said you can start with the balance as per cash book or adjusted cash book, it depends. Balance as per adjusted cash book. Then I will tell you, because under this, if you start with the balance as per adjusted cash book, sometimes the balance as per adjusted cash book is an overdraft balance, meaning the credit side is more than the debit side. But sometimes it is a debit balance, meaning the debit side is more than the credit side. So I will tell you when we are solving a question, when it is an overdraft and when it is not an overdraft. So the balance as per adjusted cash book is what you're going to start with. So if the balance as per adjusted cash book is a debit balance, they said we add unpresented checks. After adding unpresented checks, then we less. Sometimes we can have errors. There are two types of errors. We can have what we call debit errors and we can have what we call credit errors. So now, if you look at now, the unpresented checks are the checks we're going to add. Then we less what we call uncredited checks. Uncredited checks. Uncredited checks. Uncredited checks. So if you subtracted the balance we have, will be the same balance we have in the bank statement. If you don't have the same balance in the bank statement, know that your question or the solving or the solution is wrong. So we need to put that into consideration. But if the balance as per adjusted cash book is an overdraft balance, we can do the reverse. We are going to do the reverse. So the reverse will be, we are going to add uncredited checks, then we less unpresented checks. So that is the reverse. So it depends. We're going to discuss it in detail when we start solving the practical. Let's move on to the next one. Reasons for the disagreement. It's a very common question for grade 12s in WAS exams, but students find it very difficult to understand some of this. Sometimes they will ask you 5. Sometimes the question is set like this. Sometimes the question will just tell you state 5 reasons for the disagreement. Sometimes they will not ask you to state it directly. Sometimes they will state it for you and then you are going to define it by yourself. But if they ask you to state and they do not specify the items, I will advise you to take the ones that are very simple, the ones that have a simple definition. So please, under accounting, if you are asked to state, this is something that you need to put into consideration. If you are asked to state, you are not going to list. For instance, I said state. You don't have to say unpresented check. Unpresented checks. Uncredited. Uncredited checks. If you write this, you are only going to get 1 mark, 1 mark. Why? Because you are not asked to list, you are asked to state. So if you are asked to state, you need to write it first, uncredited checks, then you write unpresented checks, then you write something. You explain or you state what are unpresented checks and what are uncredited checks. Please put this thing into consideration. It's very, very important, because sometimes students lose mark unnecessarily because they don't understand the concept behind it. So state, you need to write something after listing it. But when they say list, you don't need to write anything. List 5 reasons for the disagreement. Don't write anything. Just say 1, unpresented check, stop there. 2, uncredited check, stop there. If you write further, you don't going to have the mark. Because if they say list, list. If they say state, you list, you're losing mark. So if they say state, you need to write something about that particular item. Now let's see what are some of these reasons for the disagreement. There is one thing that I want to put across. You can never able to solve a bank reconciliation question unless and until you know the reasons for the disagreement. If you want to settle problems between 2 people, the only way that you can able to solve the problem is when you know the causes of the problem. So the first thing, that's why some students, they have always problems. Whenever they are given a question, they follow what the teacher is trying to tell them, they master the solutions. That is wrong. The first thing you need to do is read the theory to understand each item. It will help you to understand the practical. But students thought that there is a difference between the practical and the theory. They are intertwined. You need to know what the theory says, and you need to know what the practical is saying. So you connect them, you can able to solve any question under the practical. But if you don't understand the theoretical aspect, you can never able to solve the practical aspect. So please, let's discuss these items one after the other. So the first one we have what we call uncredited checks. Uncredited checks. Uncredited checks. You see, sometimes some students, when they want to define this, they just look at the name. What are uncredited checks? These are checks that are not credited by the bank. So they use the name. On means is negation. Something that is credited has not been credited. That's what they mean by uncredited. Checks that's supposed to be credited by the bank and they are not credited. You know, if you want to just simply define it, you look at it like that, you see. But what I want you to do, you know, there is something like if somebody is explaining something, there is a difference between explanation and the definition you need to give. There is standard definition given for each item. Then those definition is what you need to apply whenever you are answering a question under examination, under an examination. So now, for instance, they ask you what are uncredited checks. According to what we have, these are checks received by the business and debited in the firm's cash book, deposited at the bank, but yet to be credited by the bank at the time the bank statement is issued. So what do they mean by that? These are checks that has already been received by the business in their favor from their customers. So what happened? At the time that they presenting the checks, these checks to the bank, by that time the bank has already prepared the bank statement. So that is why they say the reason for this is based on late presentation of the check. So sometimes, because the bank have to prepare the bank statement. So at the time that these people are presenting the check to the bank has already prepared the bank statement. So obviously, if they prepare the bank statement, it is not going to be indicated there. You see, the balance in the cash book will be high, but the balance in the bank statement will not be. You see, the balance in the bank statement will not reflect there, because in the cash book it has already been debited. But in the bank statement no record was made, because by right, whenever a cash book debited an item, the accounting principle said for every debit there must be corresponding credit. So the bank should credit this item in the bank statement. So they did not credit it because the check was not presented at the time they are preparing the bank statement. So You cannot blame the bank for that. You blame them for the late presentation. So the business presented the check lately because the customer paid them using check. So they have to present this check to the bank so that the bank will credit their account. So instead of presenting it on time, they did not present it until the bank statement was prepared. So now let's go to the next one. And then this check, this kind of item is normally recorded under the bank reconciliation statement. So uncredited checks are not recorded in the adjusted cash book. They are recorded in the bank reconciliation statement. So let's go to the next one. Unpresented checks. These are checks already issued by the account holder and credited to the cash book. It has already been credited in the cash book. Credited in the cash book. Because here, what happened? The bank, like for instance, the business normally is owing NAWEC, and NAWEC came to them and asking for their money. So the business was not having the cash available. They don't have any cash available into the business. So they decided to write a check for NAWEC. So NAWEC should present this check to the bank so that the bank will give them the money. So instead of NAWEC presenting this to the bank so that they can collect their money in cash, they did not present it on time. So these checks that were written in favor of the beneficiary and the person, this beneficiary can be a creditor, can be a supplier, but the person failed to present the check on time. So obviously, the cash book, the business has already credited their cash book because they are giving it out. So they already credited their cash book, but this person who's supposed to present the check to the bank so that he or she will receive his or her money, the person failed to present it to the bank for collection of the cash. So now in the bank, no recording has been made because the person did not present the check at the time that the bank is preparing the bank statement. So these kind of checks are what we call unpresented because the person did not present it after. It has already been approved by the business, already been written by the business, and the business has given them the authority to go to the bank and collect their money. But they did not present the check at the time the bank statement is prepared. As time is not on our side, we will stop here, and when we meet in our next lesson, we will continue from the reasons that causes the disagreement between the bank statement balance and then the cash book balance. Thank you so much.